Will we see gold dip below $1,000? That's the one big question. The second big question is, what does it mean for the guys that pull this stuff out of the ground?
Yeah, well, ABN AMRO says we could. They're forecasting a price of $1,100 by the end of this year, $800 by the end of next year. Now, when he says that they allocate capital $1,000, what he's really saying in layman's speech is he's ready to build a mine as long as the price of gold is above $1,000. So that's his business model. We actually looked at 19 different gold companies. 12 of the 19 at the current gold price are actually profitable. That means 7 of them aren't. Their production cost is higher than what they're able to sell the gold at. Now, if the price of gold falls by another $50, that number of 7 non-profitable gold producers actually increases by 2 to 9. So there's an awful lot of unprofitable gold production out there. In fact, we talked to one analyst who said about 1/3 of all of the gold being produced right now in the world is being produced at a loss, which is a pretty staggering concept. And what you're getting in the market, as one analyst put it, is a two-tier situation where you've got the likes of Randgold, which have been allocating at $1,000 and are still sitting pretty because they're making money as they take gold out of the ground. And you've got, if you will, the losers who, in the run-up to $1,900 an ounce, started allocating at $1,500, started building mines assuming that the price of gold was going to remain above $1,500. And they're right now obviously in a world of hurt because they're not making money right now as they take the gold out of the ground.
And if I'm looking at share prices, Ryan, is this the trend that continues? Because Randgold's been hurt over the last couple of months. On the year, though, it's really held up.
Yeah, I mean, you know, speaking of Randgold, I think one interesting thing to do is to take those two tiers and look how they compare. So Randgold, the price of its shares has been falling, but if you compare it to sort of a, if you will, second-tier company, a company that is producing right now at a loss like Harmony Miner, which is Harmony Mining, which is not in a very harmonious situation right now as South Africa's third-largest producer because their break-even cost is $1,250 an ounce. What you'll see is they're falling at a much greater rate. So that beckons the question of, well, is it time for M&A? Because what we do know is that the gold industry, with the exception of one quarter last year, has not done an extraordinarily good job at cutting costs. The break-even cost for the industry has remained for the last couple of years, if you strip out that one quarter, about $1,000. So M&A, well, you know, I was asking the CEO of Randgold about that, and he said the thing is what you get first, you're going to have to wait a little while, is gold producers effectively selling off the assets that they don't want. This is going to have to continue for some time before they start to really feel the stress, before they put themselves, if you will, up for sale. And he said, by the way, he's a little bit concerned about taking a short-term view in an M&A perspective. You heard him there say, because there is a little bit of a correction that's necessary because there's just too much gold being produced right now.